Okay, so I'm just going to try and do this quick video on the banking system. Capital and liquidity ratios. Right. So if the capital ratio is lowered, that means that the bank has become more risky because you're having more loans compared to the amount of capital that a bank has. So you need to understand that capital is really, really important for a bank. We also need to understand liquidity is also really, really important. So if you lower these ratios, the bank will be lending out more money and it will be riskier. It will be making more money in terms of its profits, but it's going to be riskier. So therefore, we have regulators for the banking system. Now, in 2011, we had the Financial Policy Committee. Their big word here is the macro system. So they will look at the whole system. And in particular, they will look at M4. The Prudential Regulation Authority is the micro system. And what they do is that they will look at individual banks. And if the capital ratio or the liquidity ratio is too low, then they will raise it, which fundamentally means that the banks will have to hold more capital, which makes them safer, and also more liquidity, which means that they'll be lending out less money. Okay, liquidity ratios, capital ratios. So then we come on to the liquidity ratio and credit creation. So if we have a credit multiplier of 10, which means that the bank must be keeping 10% of its money in cash, then 1 divided by 0.1 is equal to 10. However, if they only need to keep 1% of their money in cash, then the credit multiplier will be 100. And this will have a massive impact upon the money supply. So if it was, say, 5%, then the credit multiplier will be 20. Which means if you put £1,000 in, if it's 10, you get £10,000 out. £1,000 in, if it's 100, you get £100,000 out. So too much lending will increase the money supply. E.g., when there's too much money supply, remember MV equals PT, then we're worried that we might get inflation. Credit creation, e.g., or we could have banks where you put £1,000 in the bank, those are the assets, those are the liabilities, that bank is very safe indeed. But then they're not making any loans at all their money is held in cash. Very safe, but the bank is not making any forms of profit at all. Okay, the Prudential Regulation Authority, remember, looks at the micro system. The Financial Policy Committee looks at the macro system. Right, so prior to the financial crash in 2008, banks were regulated by themselves. So the money supply was growing at about 20% of a year. Now, we didn't have inflation then, so everyone thought everything was okay, but we did definitely have an asset price bubble, and everybody was pouring their money into the housing market. So banks were regulating themselves. And I'd always tell the story of Moody's. They gave the Lehman Brothers a AAA rating, which meant that this bank was very safe. 4 months later, the bank went under and it lost all of its money. This creates systemic risk, which is if one bank fails, then they all fail. And we also have the problem of moral hazard, whereby banks are willing to take risks because they know at the end of the day they will be bailed out by the government. And also, whilst you're taking those risks, if you're paid on commission and you're making profits, then your wages will obviously go up as well. So there's always that incentive effect to do that. There's also the question of bounded rationality, is that the regulators didn't really know enough of what was going on. If we do get a systemic risk, then the AD will fall from there. Okay, turn over a bit of paper on here. Okay, so in monetary policy now, remember monetary policy is conventional monetary policy, interest rates and exchange rates, and unconventional monetary policy, which is forward guidance, funding for lending, and the big one, quantitative easing. Forward guidance is pretty easy. The Bank of England will tell people that interest rates will remain low for a long period of time, or they will tell people that they're likely to rise. The funding for lending is to force banks to lend to the real economy, whereby if a business comes along, the business will be offered a low rate of interest, they're more likely to take out the loan, but if the loan goes bad, then the bank will be able to claim the money of the Bank of England. So in 2008, as we all know, we had the financial crash, and one of the reasons why we had the financial crash, and because of that, we had low interest rates of 0.5%. So you must all understand the transmission mechanism, which is consumption, investment, asset prices, and the exchange rate. So, however, this is an evaluation point. If there is a lack of confidence, people will not spend money. So even if you have low interest rates, it does not necessarily mean that people will go out and borrow money. But you must know that if we have low interest rates, then there's going to be an increase in consumption because it's cheaper to borrow money, increase in investment because it's cheaper to borrow money, an increase in house prices because it's cheaper to borrow money, and therefore that may create a speculative bubble. And finally, a decrease in interest rates, hot money will go abroad. Remember, we did this loads of time in the first year. Sterling moves abroad, the exchange rate falls. If the exchange rate falls, export prices fall, import prices rise. So therefore, hopefully we will sell more exports, so that will go up, and imports will go down, and therefore that will lead to an increase in aggregate demand. Okay, so this is the transmission mechanism here. But therefore, in 2009, because we weren't guaranteed that interest rates were going to work because we had low confidence, therefore we embarked upon a policy of quantitative easing, which meant that banks went out and they bought bonds. Remember, at this stage, the bond price will then go up. The coupon always stays the same, times out by 100. Therefore, the yield goes down. If the yield goes down, therefore that will lower the long-term rate of interest. QE is all about increasing AD. Right, three ways. Bond price goes up, yield goes down, long-term rate of interest falls, house prices will therefore increase. That will lead to a rise in consumption. Banks will also be safer because they hold bonds, and if the house prices are going up, then their customers are also safer. Banks have more cash. If banks have more cash, therefore they can lend out more money. Therefore there'll be an increase in AD. The wealth effect, the bond price will go up. Therefore people are wealthier. Therefore there'll be an increase in AD. We needed QE to save the banking system. The Bank of England argues that because we used QE, that this stopped unemployment from going up. So therefore that led to an increase in equality. However, a lot of people would argue that this led to an increase in house prices. That therefore led to an increase in equality. And actually, could we have spent the money in a better way? So the regulatory system, the Financial Policy Committee looks at the whole system, and then they advise the Prudential Regulation Authority, the banks lending out too much money. Remember, they will then look at individual banks, which is called micro-prudential system, and they will ask them to raise their capital ratio and also their liquidity ratio. This will therefore mean that the banks will lend out less money, and that will reduce M4, and that will therefore reduce the money supply. We've also got the Financial Conduct Authority, which is independent of the Bank of England, but they are answerable to the Treasury. So they will supervise the conduct of firms, promote competition, deregulation, and looking at loan sharks. Okay, so basically, if we increase the capital and liquidity ratio, and that will make banks safer, splitting up commercial banks and investment banks. Okay, so this was also done. So what the investment banks were doing, they were taking customer deposits and then speculating with their money. So this created a less safe banking system. So in 2019, banks had to split up between commercial banks and investment banks. Okay, how banks create credit. You should all know this now. So it all depends on how much cash banks have to give. So in this case, if the banks have to keep 10%, the credit multiplier is 10. If they keep 1%, the credit multiplier is 100. Credit multiplier, e.g., very simple system. You put £1,000 in the bank, £1,000 worth of assets, £1,000 worth of liabilities, total assets 1,000, total liabilities 1,000. The bank is extremely safe. However, if we take the credit multiplier equal to 10, the bank will be able to make £9,000 worth of advances. Now, the reason why every time they make an advance, that money is spent and then it recirculates and comes back into the bank, and that is how banks can increase their money supply. Advances equals profit, but if loans go bad and advances go down, then the bank will have less assets. Then the bank is at risk, which is why we need that capital. Banks lend money, the entrepreneur gets the money, then spends the money. Remember, that money that's spent will then end up back into the system. Okay, the balance sheet of a bank. So now we're looking big time. Cash, all of this here is liquid amounts of money. Cash, balance at the Bank of England, money at short call. This will earn a very, very small rate of interest. Beyond that, we have the sort of medium-term assets, quite liquid, quite profitable. Treasury bills, remember, they are short-term forms of money in the money market. Bonds are in the long-term capital market, guaranteed rate of interest. The Bank of England will always pay it, so very, very safe. And advances, which are loans. But that is where the banks make most of their money. Okay? Can you see the links? The liability side, every single time a customer puts money into the bank, it creates an asset and a liability on both sides. You have the capital to make the bank safer, because if the bank starts losing money through its advances, then this will eat up the capital. However, if this side is less than all of this, then technically the bank is bust. Another part of the syllabus here, if banks borrow short term, right, off another bank or from Saudi Arabia, say, but then they give out loads of money in mortgages, which is lending long term through advances, that also places the banks at risk, because Saudi Arabia might ask for all of their money back. Okay, but most of a commercial bank's assets are taken up by customer deposits. Okay, so then we have this concept of profitability, liquidity, security. We have to balance those concerns. We can't just have loads and loads of advances and make loads and loads of money. So hence we have this portfolio of assets. So you're probably really on this sort of question, you want to draw the balance sheet of the banks. Hence we have regulation. Remember, the Financial Policy Committee is the macro part, Prudential Regulation Authority is the micro part, the Financial Conduct Authority is independent of the Bank of England, which is these two things here. They look after competition and look after the consumer. So Keynes said, when the capital development of a country becomes a byproduct of a casino, the job is like to be ill done. Which basically means if banks start acting and take too many risks, then it will not serve the country well. Dealing with the concept here of moral hazard. Moral hazard is too big to fail. Banks take too many risks because they will be bailed out by the government. So in 2008 and 2009, we also had the herding effect. The herding effect is a bias. So the customers want to borrow loads of money, and at the same time, the banks are willing to lend loads of money. They're both guilty of herding. We've also got the availability bias. The availability bias comes in because if house prices have gone up in the past, they think they will go up again. So therefore, people continue to buy houses. We have the idea then of systemic risk, that if one bank fails, then they all start failing. Because remember, the advances go down, the advances go bad, which means the assets are worth less than the liabilities of a bank. So that will technically create a bank that goes bust. Then this will affect the real economy because there'll be less lending. The multiplier accelerator will work in reverse. So in 2008, GDP fell by 6%. So therefore, we then use very low interest rates of 0.5%, but they won't get to work, of course, because of lack of confidence in spending money, but you still go through the transmission mechanism and why that might work. 2009, we use QE, and 2009, we use fiscal policy. Okay, so I think this is the last one. We have an asset price bubble. And really, currently, we've had an asset price bubble. Because what happened was we had low interest rates for years and years and years. There was no point saving money. So where are you going to put your money? In either the stock market or into the housing prices. Both of those are assets, and both of those are dangerous because eventually they could both crash. So the QE also played its part because that put more cash into the housing market, more inequality. And there's also no point in saving, so therefore you invest in housing. Also with modern monetary financing, where we spent up to 450 billion quid, there's a lot of spare money at the end of COVID, so that money may well have also gone up into housing because house prices were still rising. So therefore, in 2023, our economy is in a bit of bother. Right, because it's based on consumption. It has always been based on consumption. And it's been based on government spending. And that leads to debt, consumer debt. If the consumer debt gets too big, they then go bankrupt, the bank will lose its money that it's lent to the consumer, so that's not a very good idea. There's also government national debt, that also creates a problem. Yeah, if you look at China, the Chinese economy runs on investment and exports, so they have a massive trade surplus, it's run on investment, so therefore their economy has in the past grown at 10%. So our economy runs on CAG. Right, if there's more consumption, we all know what happens. More consumption, multiplier accelerator takes off, could create demand pull inflation, will probably create a trade deficit, and that creates an issue. And then we're increasing G, national debt, crowding out affects everything else. Consumer debt, government debt. So therefore, right now we've raised interest rates, we've got this very difficult balance, but we have loads of consumer debt, which means that loads of consumers might go bust, and then that could create another financial crash. So these are very, very difficult times. We have a lot of instability within the UK economy. And that is the final one. Thank you.